Welcome to the key highlight summary on mutual fund taxation. Understanding these rules is crucial for maximizing your post-tax returns. Taxation plays a crucial role in determining the final returns you get from your mutual fund investments. It depends on the fund type, holding period, and investor status. Taxes primarily affect investors at two levels: capital gains arising from unit redemption and income distribution, now referred to as IDCW. Let's start with capital gains taxation, which occurs when units are redeemed at a higher value than the purchase price. We'll look at equity-oriented mutual funds first. For short-term capital gains in equity funds, where the holding period is less than 12 months, the tax rate is 15%, plus applicable surcharge and cess. Long-term capital gains, held for 12 months or more, are taxed at 10% only on gains exceeding 1 lakh rupees per financial year. Importantly, no indexation benefit is available here. Next, let's explore capital gains taxation for debt-oriented mutual funds, which invest less than 65% in equities. For short-term capital gains in debt funds, held for less than 36 months, the gains are simply taxed according to your individual income tax slab. If units are held for 36 months or more, long-term capital gains are taxed at 20% with the benefit of indexation. Indexation helps reduce taxable gains by adjusting the purchase cost for inflation. We now move on to income distribution cum capital withdrawal, or IDCW income, and the levy of stamp duty. IDCW income is now fully taxable in the hands of the investor and is taxed as per your applicable income tax slab. Mutual funds no longer pay dividend distribution tax. A stamp duty of 0.005% is levied on the amount invested, applicable on purchases, SIPs, and switch-in transactions, and is deducted at the time of unit allotment. Next, let's understand how capital losses can be set off and carried forward, and where securities transaction tax, or STT, applies. Short-term capital loss can be set off against both short-term and long-term capital gains. Long-term capital loss can only be set off against long-term capital gains. Unadjusted losses can be carried forward for up to 8 years. Securities transaction tax is applicable only to equity-oriented mutual funds and only at the time of redemption or sale. It is not applicable to debt funds, nor can it be claimed as an expense. Finally, we cover tax benefits, tax deducted at source, and the applicability of GST. Equity-linked savings schemes, or ELSS, qualify for a tax deduction up to 1.5 lakh rupees under Section 80C, but they have a mandatory lock-in period of 3 years. Tax deducted at source, or TDS, is applicable mainly to non-resident investors. The TDS rates depend on the type of capital gain and the nature of the mutual fund scheme. GST is not charged directly to investors, but is levied on the expense ratios paid by the mutual fund, which indirectly impacts the net asset value, or NAV. Mutual fund taxation varies significantly. To maximize your true benefit, align your investment decisions with tax efficiency, holding period, and your financial goals. Remember that tax laws are subject to change. The information provided is for educational purposes only. Always consult a qualified tax advisor before making investment decisions.